Hi everyone, it's Jack about another video. Gotta make a video today because Intel have just released the Q2 earnings and they absolutely stunk. It's down almost 8% after hours, surely to be down more tomorrow because these results were really not good. It's actually pretty worrying for the wider semiconductor industry with some of the things they've been saying about cyclical slowdowns and things like that. It's already a stock, which by the way I am a fan of, but is doing putrid this year, down 25%. It's been on a long-term stock decline, 52-week high of $56. It's now pretty much at its low of, well, it's 36. Its 52-week low is 35. It's surely going to be 35 tomorrow because I think this report is going to be perceived really harshly. So I'm going to go through it, tell you what I think, tell you if there's any good news to be had whatsoever, and whether I think this is a danger for companies like AMD, Nvidia, Micron, other big names that many people are invested in that could be on the receiving end of a long earnings season. So before we get into the reasons of why these results are as bad as they are, let's actually look at them. Revenue, $15.3 billion, that's down 17% year over year and is $2.7 billion below their April outlook. That is a huge miss. Like they were clearly not expecting it to be this bad, or they were dishonest about it, and that's just on the revenue side. It actually gets worse. Their earnings per share was down 79% year over year, and is more than 50% below the April outlook. It's 41 cents below their April outlook. They only recorded 29 cents of revenue per share. This is a nearly $40 stock. That is absolutely putrid. That would, if they repeated that 3 times, that gives Intel a price to earnings of like 40. It's currently trading at a price where earnings like on a trailing basis of about 7. This is absolutely putrid earnings per share numbers. The gross margin was down 15 percentage points year over year. Intel's gross margin is typically in the 55 to 60 range, 60 being more ideal. 44.8% gross margin, while not a bad number overall for an ordinary company, it's absolutely terrible for Intel's normal performance, and they were already expecting this to be significantly down. They were expecting it to be around 50%, so it's 6.2 percentage points below the April outlook. I really can't get across to you how much of a miss this is. This is absolutely terrible results, and they deserve to be down far more than the 7% they are. That's why I'm predicting that they're going to be down much more significantly tomorrow. In terms of the why, they think there's a near-term cyclical slowdown in the semiconductor industry. They're expecting an approximately 10% decline in the 2022 PC total addressable market. They're seeing prolonged supply chain challenges. While they think this is a near-term cyclical slowdown, and they see long-term sustainable demand across their 4 superpowers, being ubiquitous computing, cloud-to-edge infrastructure, AI, and pervasive connectivity, they think it'll eventually expect the ongoing TAM to be above 300 million units, but right now they're seeing the compound annual growth rate data going backwards. They believe they're in a cyclical slowdown, and this could be really bad for the rest of the industry. Continued customer inventory reductions because they're not seeing the demand, and I'm predicting, well, if AMD give poor numbers as well, then you kind of think, okay, the industry is doing poorly. If AMD give okay numbers or above average numbers, then Intel is in deep water, in my opinion. They'll be doing significantly worse than the competition. I'm hoping that this is a more industry-wide secular decline, temporary near-term cyclicality, as we often see in the semiconductor industry, and that Intel doesn't have a consistent problem, because this is getting towards sell basis where this is breaking the thesis for Intel. The Intel is firmly a comeback story, and if it's going backwards, this really it's getting towards sell. So I need to see what AMD, Nvidia, Micron, what other companies in the sector are doing. Looking at the revenue by segment, the one that got hit hardest was the client computing group, which is the largest by far. This is basically the PC. They mentioned PC demand softening, primarily in consumer and education, as well as the OEM inventory reductions. Obviously, brutal operating income loss on low revenue base, more unit costs, supply chain, there were investments in the process, blah, blah. This was widely to be expected. What wasn't expected was a 25% downturn in revenue. So they were expecting minor growth, single digits, maybe 10%, and they got 25% down, and operating income down 73%. That is terrible. Operating margin down 29% from 39% last year to 14% this year. Now, of course, you get economies of scale as you go up, but as revenue comes down, it really shouldn't be dropping this much. This is absolutely terrible numbers in my opinion. Moving on to the data center and AI group, which they didn't name specifically because the PC group did much worse, but this was still down 16%. And while the revenue number is about half of the client computing group, this is still a significant part of the business that has been chewed away by AMD and Nvidia in the past, and they really need to get a hold of it. Operating income down 90% and operating margin of just 5%. That is absolutely terrible. Lower revenue on OEM inventory reductions, mix-driven ASP decline, and competitive pressure. Well, competitive pressure is just not really a reason you can give reasonably for revenue decline. That's just saying that you are losing out to your competition, and that is not what you want to hear from an effective, investable business. $5.5 billion down to $4.6 billion, so a revenue decline of 16%. Terrible operating income. This is a really, really bad report so far. The third main segment is the network and edge group. Now, this wasn't as bad. Revenue was actually up 11%, but because this is the smallest segment, there's nothing to save it from those terrible declines in the other two. But again, operating margins were still down significantly from 29% last year to 10% this year. They lost that economies of scale. A product mix shift, lower inventory sell-through, and further investments gave just a $241 million operating income, down 60% year over year. This record quarterly revenue, which is a record even though it's only up like 10%, was led by strength in networking, Ethernet and 5G products, which all have secular tailwinds and are kind of outside the semiconductor space. There are emerging business segments which are going to be important growth levers for Intel in the future, but have not been consistently profitable over the long term, are the accelerated computing system and graphics group, which was up 5%, but a much higher operating loss, far above its revenue. Its revenue is up 5% year over year from $177 million to $186 million, but it recorded a $507 million operating loss on inventory reserves and roadmap investment. That is just not good enough. A $507 million loss for something that's growing 5% year over year. That is awful. Mobileye, which is the self-driving cars segment, had decent quarterly revenue, 41% year over year. That's a decent increase. Operating income actually up 43%. This is a business segment that they were thinking of spinning off a significant part of it, and I bet you they wish they'd done that a while ago at the top of the market, because they could have been generating something like $20 billion of revenue of cash for that, which they desperately need now to invest in products, because as you're going to see in a minute, the free cash flow has taken a massive hit, and that could cause widespread effects for the larger business. Intel Foundry Services switched to a loss this quarter on lower revenue and ramp of IFS operations. IFS revenue down 54% year over year due to lower sales, basically lower sales of mask writing tools. This is a small segment of the business, but it's something they're going to crucially need, because as they change a part of their business model to compete with the likes of TSMC and Samsung. This is going to be heavily backed by the tons of US money from the CHIPS Act and the FABS Act and things like that. This needs to be an important business segment in the future, and it's halved its revenue this year. That is brutal. The outlook for the rest of the year didn't look that rosy either. $65 to $68 billion of revenue expected. That's going to be down 9 to 13% year over year, which is down $8 to $11 billion from the prior outlook, which would have been something like a 5 to 10% growth year over year. I think they were expecting around 8% revenue growth. That's bad, put it that way, but that's manageable if it's a secular decline, which again, we need to look at what the other companies in this space are achieving when they report soon. 49% gross margin, just down 9 percentage points, 3 percentage points from the prior outlook. So they're already predicting gross margin to decline, but it's declining even faster than they were predicting. And an earnings per share of $2.30. Right now, it's about to be a $36 stock, so you're looking at a price to earnings ratio of 15 on a forward basis. That's significantly more expensive than it was yesterday. This is already becoming a company that is much less investable right now. That's going to be down 57% year over year and down $1.30 from the prior outlook. Really, really bad. That's not to mention that they're expecting a net capex of $23 billion. The market cap of this company, tomorrow, it's probably going to be around $150 billion. $23 billion market cap. Capex, is extremely significant for this company. That is an enormous percentage of the market cap. This is extremely significant. A lot of money going into this. This will be helped by, the chips out of the Fabs from America. But there's a lot of money going towards it. And that is at a time where the free cash flow is basically rolling to zero. So I think definitely any future share buybacks are going to be non-existent. The dividend is certainly going to come under pressure. It's yielding nearly 3.7% right now. I would think that is going to take a cut if things don't turn around very quickly. And I'm worried for the financial future of this business. Overall, do I think this is a terrible company? Absolutely not. It's definitely still got potential. And the story, if you're investing in this company, is you're expecting it to turn around and return to its former glory, to catch TSMC, which broadly the business is making strides to do on 7nm and 5nm scale. It's investing heavily in this with that $23 billion in capex. But right now, it's a very tough hold, and I wouldn't be buying at these prices because I can see further pain in the future. If AMD and other companies come out with similar results saying that this is a secular cyclical decline for the semiconductor industry, then things won't be as bad as they seem, but the stock is going to take a near-term hit because it is just an objectively less attractive investment. It's got a lot higher valuation, almost overnight. However, this won't be the end of the world. If this isn't the case and this is an Intel-specific problem, then this is starting to look like an uninvestable business to me and starting for me to turn towards hold to a sell. So right now, I'm holding on. I'm seeing what's happening in the next few months. But this is really worrying for Intel as a company, and it's definitely not a good sign. One of the worst earnings reports from a generally quality business, not a shit company. One of the worst earnings reports I've seen in a long time. Let me know down in the comments what you think about Intel's earnings report. I'd love to hear if you thought it was good. Let me know whatever you think, whether you think this is a buy or a hold. Like, subscribe, and enjoy the video. I'll see you again next time.